Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 3rd of May. I'm Daniel Lam, your host for the podcast. It's great to be finally back at the office after 2 weeks of paternity leave. It's always good to interact face-to-face with colleagues and to listen to the FAQs. So one of these is about the strong performance in US equities. Indeed, S&P 500 index has been challenging year high and may even go to test the one-year high at 4,325. The outperformance is even more prominent in Nasdaq 100, where it may potentially challenge the critical 13,700 resistance level. So why the strength in US equities when there's a recession looming? Well, it had to do with discrepancies between short-term and long-term signals. So in the long term, traditional recession indicators continue to point to a relatively high probability of a US recession over the next 6 to 12 months, as shown by warning signs across most of our US recession checklist, a high recession probability on our quant model, and a still bearish signal from our growth inflation model. Now, despite this backdrop, global equities have remained very resilient. A robust US job market leading to sustained consumption and an extremely bearish investor positioning are likely behind the resilience. The S&P 500 index positioning data supports anecdotal evidence that many investors have already positioned for bearish outcome. Fund manager surveys illustrate similarly bearish sentiment. The other reason is the relatively strong showing in the US earnings season. Key sectors such as consumer discretionary, financials, and technology are showing double-digit earnings surprise. Yes, we know that weaker consumption trend is likely to be a long-term headwind. But stocks with niches are countering this phenomena, such as those involved in areas in ChatGPT or AR/VR, or those consumer staple stocks that are able to pass on the impact of inflation to the customers. As such, we believe there's still likely to be some room for US equities to do well over the very short term, especially stocks in those niche areas. However, for medium to long-term allocators, investors should look to rotate from equities into high-quality fixed income and multi-income assets. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.